Well, good morning. I just want to give you guys a quick update on some of the things that have been going on and what we've been doing with respect to portfolios. As you know, February 25th was the date that we chose to sell out of all equities. We bought some treasuries, made a trade on that, been sitting in cash for most of the time since then. Yesterday, because interest rates have spiked so ridiculously in such a short period of time, I decided to make one more treasury trade based on a number of technical factors. Uh, I didn't expect to close that trade in a day, but I did, and total gain on that was somewhere between 2 and 3% gross. Depending upon the risk level of the portfolio you had anywhere from 35 to 55% exposure to those particular treasuries. So let me share my screens with you real quickly, give you a couple of updates. I hope everybody's comfortable and safe and not ill or anything like that. And if you are, I hope you get through it super quick. But on this end, I want you to feel confident and comfortable that we are taking risk measures very, very seriously. We will continue to, because I'm not so sure that we've seen the bottom yet for a whole host of reasons, which I'm going to share with you real quickly right now. So when I talk about interest rates, this is a picture of the 10-year Treasury Yield Index, symbol TNX. And what we see here on March 9th is the Treasury Yield Index bottoming out at 0.398. That's right, the 10-year Treasury traded as low in terms of its yield as 0.398%. In just 8 trading days, yesterday, the 10-year Treasury hit a high of 1.266%. Now, just to give you the severity of that move, that is a grand total of about a 220% upside move in interest rates. Almost unprecedented. When you get that kind of a scream in interest rates, it's telling you that something's not right across the board. And many people have wondered, well, why would that be? Why would interest rates be accelerating so rapidly? Why are people selling treasuries so rapidly? And the answer is that you've had this whole host of levered long hedge funds that have been provided with massive amounts of free money through their margin arrangements. And with the equity market getting pummeled the way that it has, these levered longs, in other words, their net leverage may have been 200%. And now they're maybe neutral. So their net leverage is now down, but now they're having to take down their grosses. And when you're dealing with net levered long hedge funds with margin calls, they don't sell what they want. They sell what they can. And so the most liquid thing on the planet has been and will always likely be treasuries. And so therefore, those treasuries sold off. This is not too dissimilar than what we saw back in 2008. We've seen this movie before, and I'm going to share that with you as we go through this. But what I wanted to show you was just this move in interest rates. So yesterday, getting close to the close, we bought symbol TLT, which represents 20 plus year treasuries, right about here with an interest rate of about 1.2%. So in other words, when the 10-year Treasury hit about 1.2, we started initiating trades in that long-term Treasury with the anticipation that we would hold on to it for a gain that might come out over a period of days or weeks. However, this morning we woke up and the 10-year Treasury yield was already down to 1.13%. Now that's a pretty big drop in a fairly short period of time. And so TLT found itself in a position where we bought it at about 143 and we sold it up here at about 148. So whenever you can book gains in a market like this, we want to take it, you know. And one of the main reasons why we did it is there's this thing called the MOVE Index. The MOVE Index represents bond volatility. And when the MOVE Index moves out, bond volatility is increasing dramatically. And one thing that you have to remember in markets is that asset class volatility creates uncertainty. And money will always move from high amounts of volatility to low amounts of volatility. So right now we have an unprecedented amount of volatility in stocks, bonds, oil, Bitcoin, gold, you name it. And when volatility levels are as high as they are in asset classes across the board, the only safe place to be is cash. So therefore, I made the decision this morning to book the gains, get out of the treasuries, and sit back and wait. because what I didn't want to have happen was get in a situation where, due to more panic or more unprecedented moves by the Treasury Department, that we see a real spike in interest rates. And some people might be sitting back and saying, well, how is it that we can get a spike in interest rates if the Fed's cutting? It happens. It's happened globally, and it has happened here recently. Again, let's take a look at TNX, which is the 10-year Treasury yield. And you can see that obviously during this span of time, the Fed was massively doing whatever they could to put themselves in a position to cut interest rates and provide liquidity. I mean, good grief, they went from 1.2%, 1.25% in U.S. Short-term interest rates to zero, and yet interest rates spiked this much. So wouldn't it stand to reason that if globally we continue to see interest rates drop, that we could see a spike in interest rates? And the answer is I don't know. So what I do know is that when the rules of the game get unreadable, you don't play the game. And so therefore we sold out of the Treasury, sit in cash, and now we wait. So we just wait for that institutional event to move on. So I commented that this movie has been seen before to some extent. And what I mean by that is in 2008 and in 2001, there were some similarities to both of those instances to what we're dealing with today. In 2001, we had shutdowns across the board. In other words, businesses were closing left and right due to the terrorist attacks and the fear that many people felt at that time. Obviously, due to this COVID-19 virus, we have a lot of business shutdowns happening across the board. And we've not seen even the tip of the iceberg as it relates to unemployment numbers. And this week's numbers were certainly not great in terms of new unemployment claims. But next week, you're going to really see those numbers rip higher. How much? I don't know. But when you think about the market and how it responded to these instances in previous crisis-bound environments, one of the things that comes to mind is the 2007-2008 cycle. The market topped. When I say the market, I mean the equity market, the S&P 500. Market topped in October of 2007. The Federal Reserve rapidly started cutting interest rates, and meanwhile, the stock market dropped about 20% to about the end of March 2008. From March 2008 until about mid-June 2008, interest rates ripped higher. Sound familiar? Kind of looks a little bit like what we've been dealing with now. And yet from June 2008 to the bottom of the market, which was March of 2009, the S&P 500 lopped off an additional 50%. So some people sit back and say, oh, the market's dropped roughly 28%. Certainly the bottom has to be close. I don't know. What we will know is that when the institutions choose to draw a line in the sand, those tracks are very hard to cover, and we'll be able to identify it with some of the tape reading that we do and some of the other institutional types of indicators that we use to help us figure that out. But in the meantime, this remains a fairly dangerous market for a whole host of reasons. The Fed shot every bullet that they had last Sunday. And I don't agree with the way that they did it, coming out on a Sunday without anyone who trades with the capacity to respond or react to it and whatever. But ordinarily, the Fed doesn't shoot the bazooka until they need to protect the house. What's the house? The house is unemployment. They shot the bazooka at full employment. So what are they going to do when the unemployment rates start to skyrocket? And what we have to remember is that unemployment rates don't just slowly start to go up once they curl north. They go straight up. Is that going to happen this time? I don't know why it wouldn't, especially considering all the things that are going on right now. So the bottom line is that this is a very different environment. This is a very strange environment. The rules of the game are very different these days than what they have been in the past. But what we do know is that human nature, fear and greed, always has a tendency to respond the same. And therefore, bottom processes, and that's important to recognize. Bottoms are a process. They're not usually an event. They happen over time. And so therefore, we have to be patient with those bottoms and take opportunities for potentially booking some gains along the way when we can. And so therefore that was one of the reasons why we decided to make a treasury trade, and why I chose to get out so early as opposed to potentially go through some volatility. Once that move index comes back down a little bit, we might decide to do something else along those lines. But for the time being, we're just going to be patient. We're going to be sitting as much as we can in cash, wait for that institutional volume process to identify when the market appears to be going through that bottoming event. And every time so far that we've gotten that upside day, the next day it's been wiped out. So we're just not seeing the bottom yet. How far below from this current scenario that we're sitting in could the bottom be? I don't know. That's a great question. It wouldn't surprise me to see the S&P 500 trade down to levels that were equal to about the 2015-2016 highs. And that's about another 7 or so percentage points below where we currently sit. So patience is the word. Patience is the game in the process. So that's where we're standing right now. I just wanted to give you a quick update on how we've been processing this situation and managing this scenario. If you have any questions at all, please reach out to me and let me know. There is no such thing as a silly question in an environment like this. So I'm thankful and happy to help you in any way I can. Always thankful to work for you. Direct line 608-354-1977. Email, of course, chris@careformywealth.com. Stay safe, stay healthy, and God bless. Thanks so much. See you soon.